Yeah, what's good guys? Welcome in this new video about the Fib. I was recording before, but I didn't see that my fucking OBS was not recording. But anyways, let's start without any more hesitation. Basically, let's check if we are recording. Yes, okay, perfectly. So basically the Fib and the standard deviation stdv are the tools that we use for confirmation for our entry, or we can use it if we as a safety net, as I wrote here, if you miss your first entry, and yeah, help to refine entry points. What are the main characteristics about the Fib is that it's valid on pretty much any time frame. It's not good with consolidation price action. You can use it, but it's preferable not to use it with the choppy price action. Price usually get aggressive near the 705 level. What does it means? That basically when we are near the golden pocket level, as I wrote here, I'll explain. Basically, it means it's a name that we use to call the level from the 62 to the 79, and yeah, when we start to approach these levels, the price usually reverse aggressively, and yeah, it's great to use and combine with the IMD or engineered liquidity. Engineered liquidity, I didn't explain it yet, but it's basically very good formulas on liquidity that we know market maker might want to sweep or take out. The best level about the Fib are basically the 0.5, which is basically equilibrium if you studied for TJR, from TJR, and it's very useful when you play out with the higher time frame and bigger stop loss, not very useful with the top tick or bottom tick. So if you have a higher time frame strategy, or however a standard ICT strategy, it could be a good way of using it. For example, we can touch like this, we can enter into the equilibrium, which is the 0.5, and then continue the reversal. And it's very good if you have a strategy that is formed out by liquidity sweep, fair value gap, and this type of things. Okay, then we have yeah, the 62, which is good if aligned with other confluence, standard confluence like the engineered liquidity, FG, key levels that I all explained, except for the engineered liquidity. Maybe it will be the next video. And where is the thing to draw? Yeah, there we go. So good if we aligned it with other confluence. Then there is the 705. It's great also with other confluence, and the stop above the 79 level. What does it means? That if we use this lag, manipulation lag, and we want to use the 705 level, we put like that, for example, and the stop, if 10 point, we use it like this, so it's basically above the 79 level. While if we target directly the 79 level, we can do 5-point stop loss, so higher risk reward, or even 2-point stop loss, which is as you can see a perfect high risk reward. And what else? Yeah, the 705 is great with imbalanced order block setups, which I didn't explain yet, but yeah, you'll see it. So subscribe to the channel and watch the whole series if you want actually to become a top tick trader and trade like this, basically with this style. Yeah, and the 7.9, in my opinion, is the best for aggressive entry. you want to use it, of course, with a clear bias and context, so not any times, but if you know that this was just a retrace and this was the point of reversal, for example, it's a good level. And yeah, this level here are called optimal trade entry or either golden pocket. The standard deviation, I'll tell you more about it later. Okay, let's delete these sheets. And yeah, here I have a perfect example of what a good use of the fib could be. If, for example, my initial entry was here, but I missed it for some reason of, or maybe it wasn't enough of a confirmation. I want the fib to see if it was actually a good level. We wait for the retest, for example, here of the 7-9 because we had enough levels and confluence here for the first entry, so the 7-9 is good. We put a 2-point stop loss. Usually the TP is here, so the start of the retrace, but we can do even bigger. We can do the stdv. So like this is actually, this aren't actually the level of the standard deviation, but I'll tell you more about that later. So like this, let's see how this play out. Yeah, tag it in. Immediate reaction, as you can see, very aggressive reversal, as I told you before. This is the first TP, then we aim for the -2, or either -5 is good. Let's see how this play out. Okay, perfect. With the final TP. And this is 92 risk rewards, as you can see, just with the fib and this just 2-3 concept that I explained it to you previously, and that's crazy. Just see 700 point of, no, sorry, 200 point of TP and 2 point stop loss. Yeah, that's actually crazy. But even with a 10-point stop, it's 20 risk rewards. That's absolutely crazy. And okay, that's basically the fib. If you want another example, let's do it. This is a good example. Perfectly touch the 7-9, because we always do, as I told you, 1 point down the actual level, not only for the fib, but with the Wixie or the AMD of whatever. So 1 point, this was 5.25, so yeah, basically like this. We do 2-point stop loss. What the fuck? Okay, perfect. And another crazy risk rewards. Vediamo. Let's see. Fucking consolidation. Yeah, we had this form of liquidity here, so basically maybe the TP would have been this one or this one, but it's fine. This is still a crazy, yeah, see how crazy that is. Just with the fib, basically. I don't think we will hit the final TP. Oh yeah, we hit it. So that's crazy. Now with the standard deviation, what it is, it's just another levels of the fib, but used in a different way. Let's hire the time frame. Okay, so basically the notes about the standard deviation are this. We use this level -2, -2.5, and -4. What else we can use? I'll just tell you, and maybe like this. I have my notes here. These are the notes for the standard deviation. The manipulation lag, we use the standard deviation is when we use the fib on the manipulation lag, as you can see here. That is the one that sweep the internal liquidity. We have a model which is called London standard deviation, as you can see here, which is a model itself, and I'm gonna explain to you after explaining in general what a standard deviation is. And yeah, this is the level. Basically, that's all you need to know. How we use the standard deviation then? For TPs, so the most basic way, we use the manipulation lag. In this case, I don't have any good example. Yeah, maybe this. This is swept this internal liquidity right there. That was the manipulation lag. So we do like this. It's not very beautiful, but whatever. And what we want to do, yeah, we do of course like this from the top to the bottom of the manipulation. Yeah, so in this case, basically, this is a good example. As you can see, we take from the manipulation lag here to from here to here. This is the manipulation that swept this liquidity at this sells the buy side liquidity. What do we use it for? Our TP. Example, the -2.5 and the -2 are the best TPs. So like if we entered with the 10 contract, -7 or 8 here, or maybe if we had some liquidity here, we would have taken out some contract here, then other two here, and the final one usually around -4. In this case, we didn't play out. That's why we always need to trail our stop loss. So that was a good example. Basically, we use it for TPs in our normal, or at least that's how I use it. But some people use, some trader use it with for entry, basically. And these are the nodes for entry. So the main model for entries is the London SDV. Basically, what does this mean? It means that we catch we use for the fib the last manipulation leg of the London session. So before 5 AM or 5:30 AM. If you have the indicator, I think I have it. It's this basically, I think. Yeah, that's it. In this case, the last manipulation, I don't know if that's a good example, but yeah, we start from, as you can see here, we start from the 50 minute. If the last manipulation leg doesn't look good, we scale down to the 5 minute and then the 3 minute. We do it, we place the fib from week to week. So let's just do an example. And if the price action is bullish, we mark out the SDV to the upside, and vice versa for the bearish price action. Sorry, this is before 6, but yeah, whatever. Okay, in this case, the 15-minute last manipulation was this shit, but it's not good, so let's scale down to the 5 minutes. For example, this is the last one, but it's not that clear, so we use this. It's an uptrend, so we want to catch the reversal of the uptrend, so we mark this out. Sorry, not like this, from the bottom to the upside, and we aim exactly for the -2 or the minus 0.5. It depends on which level we had other confluence. So let's say if we had here some good other confluence or key levels, or whatever, maybe an FVG, an order block, whatever, we put, for example, our position to the -2 here, and our stop loss above our level, so in this case, for example, 10 point or even 7 point, because we have the 50% of the imaginary fair value gap. But yeah, usually with the SDV entry, London SDV, you want 10 point stop loss, and we aim for whatever we want. Usually I do standard 40 point, and then I do break even. In this case, it was not a very good example because the price action was continuing to the upside, but it's fine. Yeah, another example, let's do like this. Okay, so this is the manipulation leg. No, yeah, this is basically the last manipulation leg. So we do like this because it's no, it's a downtrend, so we would use it in the opposite side, so like this. I think this went up, so it was a no trade, but you understand the concept. That's the main thing. Yeah, it went to the upside, so it's fine. Another example, hopefully, which play out. The 3-minute is not very good either. Okay, this was basically our manipulation leg. Sorry, I fuck up all the time. This is the manipulation leg, here and here. Not good because we don't have really a wick, so that's not very. Maybe we could do like this, but yeah, not a really good stdv. Let's see. No, we fucked up. We no trade either. Maybe we see a good reaction here. Let's say hypothetically we had other concept and confluence aligned in this level, like this fair value gap. This is not really a good level, you need the bias and everything, but let's see. I don't remember how this play out. And 7 point above the 7.5, sorry, 10 point. This was a nice trade, whatever, 40 point got it, but not on minus 2.5. So as I told you, you must use it with context and everything, as always. Yeah, this was not a price action to trade the standard deviation. See, this is very choppy. The first rule that I told you, not use the fib with choppy price action. But I think you understood the concept. These are the notes. Screenshot it and copy it, basically. If you have any more questions, this was a long video because not that easy to understand, but it's once you master it, it's very easy. And I hope you understand everything. See you in the next video.